Welcome to the Deep Dive. We're your shortcut for getting up to speed on complex topics fast. Today, we're zeroing in on Texas, specifically the 2025 Conforming Loan Limits, or CLLs. Now, this might sound a bit dry, but stick with us. These numbers basically dictate the kind of mortgage you can get, your interest rate, how much house you can actually afford. Seriously, if you're thinking about moving, maybe refinancing, or just trying to figure out the housing market between places like, say, Austin and San Antonio, these limits are critical. So our mission today is to break it all down for you, make it actionable.
Right. And to kick things off, let's just quickly define what we're talking about. A conforming loan limit. It's simply the maximum loan amount that Fannie Mae and Freddie Mac, those big government-sponsored enterprises, are willing to back. Think of it like a cap for the standard, most common type of mortgage. And the key thing for you, the listener, to grasp is why staying under this limit is usually a good thing. Loans within these limits, they're easier for lenders to bundle up and sell, and because they're easy to sell, lenders can offer them with some real advantages. Generally easier to qualify for, you often get lower interest rates, and importantly, you usually need a smaller down payment compared to loans above the limit.
Okay, let's unpack that. These are big numbers impacting the whole Texas housing scene. So how does the FHFA, the Federal Housing Finance Agency, actually decide these limits? Is it just like guesswork?
No, thankfully not guesswork. There's a definite methodology, though it does kind of explain why the limits sometimes feel like they're playing catch up with the market. Basically, the FHFA calculates them every year. They use data from their own house price index.
House price index.
Right. Yeah, they track the median home price for different areas. The standard limit is generally set based on, a calculation involving that median price for a given region. If prices go up, the limits usually follow suit.
So it's reactive then. It's always looking backward at what prices were doing, which is super relevant for Texas cities that have seen crazy appreciation lately, right?
Exactly right. The 2025 limits, they're based on price data mostly gathered during 2024. So for context, let's look back. In 2024, the baseline limit for most counties in Texas was about $726,200.
Okay.
And in those designated high-cost areas, the cap was closer to $1,089,300. That was the ceiling last year.
Got it. Which brings us to now, 2025. What are the new numbers? What's changing?
Well, we are seeing increases. They reflect that home prices, while maybe not skyrocketing like before, are still appreciating across Texas. So the new baseline limit for most Texas counties, it's going up to $750,000 for 2025.
$750,000.
Okay. And for those specific high-cost counties, think areas around Austin, maybe parts of Dallas, the maximum limit, the absolute ceiling, is rising to $1,125,000.
Wow, okay. So that's a jump of nearly $24,000 on the baseline and almost $36,000 on the high-cost max. That feels pretty significant, especially for those expensive markets. But, I mean, thinking about Austin or some suburbs, houses can blow past $1 million pretty easily these days. Is that $1.125 million really enough to keep a typical move-up buyer out of needing a jumbo loan, which we know has tougher rules?
That's really the million-dollar question, isn't it? Or I guess the $1.125 million question. Now, look, the increase definitely helps, no question. But is it enough? That totally depends on the specific neighborhood you're looking at. What the higher limit does achieve immediately is it widens the path to affordable financing for more people. It means more Texas buyers looking in that, say, $750K to $1.1 million range can stick with these more advantageous conforming loans.
Instead of being forced into something else.
Exactly. Imagine if the limit stayed flat or went down. You'd instantly push thousands of people just looking for a standard family home, maybe into needing jumbo loans, which are more expensive and harder to get.
Right. Okay, let's connect this to the practical impact. You mentioned 4 key consequences for homebuyers when these limits shift. Can we walk through those? Because this is where it really hits home financially speaking.
Absolutely. Let's break it down. First off, loan eligibility. Simple as that. Higher limits mean more people buying slightly more expensive homes can still qualify for these standard government-backed loans, which for lenders is great because those loans are easier to manage and sell off.
Right. If the lender can sell the loan quickly, they have more cash to lend out again. Increases liquidity.
Precisely. And that ties into the second point, interest rates. Because Fannie and Freddie are backing these loans, the risk for the lender is lower. And lower risk generally means lower interest rates for the borrower. Conforming loans almost always have more competitive, stable rates than non-conforming or jumbo loans. Over 30 years, that difference is huge.
Especially in a market like Texas, where prices are high. Financing, say, $800,000. Even 0.5% difference on the rate adds up to serious money.
Huge money. Which brings us to number 3, down payments. This is a big one. Conforming loans often have much lower down payment requirements. Jumbo loans might demand 20%, sometimes even more. But with a conforming loan, you might get in with as little as 3% or 5% down. That's a massive help, especially for first-time buyers or even just keeping more cash on hand in expensive cities like Dallas or Houston.
Keeps your savings intact. Makes sense. What's the fourth point?
The fourth one is about refinancing options. This is key for current homeowners. Let's say you bought a house a few years ago and it's gone up in value quite a bit. These higher limits might give you more flexibility. You could potentially refinance to get a better rate, or maybe tap into some home equity without having to cross into that jumbo loan territory. You can stay within the easier conforming guidelines.
That's a really clear breakdown, and it really highlights how different the impact is depending on where you are in Texas. That $750,000 baseline matters in one county, but in parts of Austin, that $1,125,000 ceiling is the number everyone's watching. So this leads us perfectly into that crucial difference: conforming versus non-conforming, or jumbo loans, as most people call them. What actually happens when your loan amount goes over that $1,125,000 maximum?
Right, you cross that line and boom, you're in jumbo loan territory. And the difference is fundamental. Conforming loans, standardized, backed by Fannie or Freddie, easy to sell jumbo loans. They exceed those limits. So they're typically funded by private lenders, often banks, who usually keep the loan on their own books. They're not selling it off to Fannie or Freddie.
And if the bank has to hold the risk themselves, what does that mean for me, the borrower?
It means they're going to scrutinize you much more closely, plain and simple. Without that government backing, the lender is taking on all the risk if you default. So naturally, they put up higher barriers, stricter requirements on your finances.
Okay, let's compare them directly. Features side by side.
Sure. Limits. Conforming caps out at $1.125 million in those high-cost Texas spots, $750K elsewhere. Jumbo is anything above that. Backing. Fannie, Freddie for conforming. Private lenders for jumbo. Now the requirements. That's where it really diverges. Interest rates. Jumbo loans, almost always higher than conforming. Lenders charge more because they're taking on more risk and the loan isn't as easily sold.
Okay, higher rate. What else gets tougher? Credit scores? Down payments?
Both, absolutely. For a conforming loan, maybe a 620, 680 credit score could work in some cases. For jumbo, lenders are often looking for pristine credit. Think 720, maybe 740, or even higher. And your debt-to-income ratio, your DTI, they'll want that lower too. Plus, they'll want to see more cash reserves left over after you close.
Reserves? You mean cash in the bank?
Exactly. Liquid assets, a conforming loan might require you to show you have enough saved to cover, say, 2 months of your mortgage payments. A jumbo lender, they might want to see 6 months, 9 months, maybe even a full year's worth of payments, principal, interest, taxes, insurance sitting in your account. They need to know you can handle bumps in the road because they're carrying the full risk.
Wow, okay, so if I'm buying in Dallas, looking at a $1.2 million house, that extra $75,000 that pushes me over the conforming limit suddenly costs me potentially a higher rate, definitely bigger down payment, probably 20% plus, and a much tougher check on my credit and savings.
That's the reality. That's the trade-off. Conforming loans are built for the typical home purchase. They prioritize access, keep things standard. Jumbo loans are for higher-priced properties, and they demand borrowers with really strong financial footing to offset the lender's increased risk. So yeah, staying under that $1.125 million limit if you can, that usually gets you the most competitive and accessible financing in Texas.
Okay, so wrapping this up, what's the main takeaway for you, the listener, trying to navigate the Texas mortgage market right now?
I think the bottom line is, knowing these 2025 conforming limits is absolutely fundamental. It directly impacts your eligibility, what you can afford, your actual buying power. Whether you're in a booming metro or a smaller town, these numbers matter. The increase helps, sure, but that ceiling is still a hard line.
Absolutely. And the key action step for you as the listener, you have to get specific. Texas is huge. Markets vary wildly. You need county-specific loan limit guidance. That $1.125 million, that's only for certain designated high-cost counties. Step just outside that zone, and your limit could drop right back to $750,000. You need to know your number.
Huge difference.
Massive. And maybe even more critical, get pre-approved, talk to lenders, compare rates, and really understand how close you are to that $750K or $1.125 million line for your county. Planning around that specific limit. That's how you find the best mortgage strategy for your situation in 2025.
County-specific limits and pre-approval.
Got it. Okay, let's end with a final thought, something to chew on, based on everything we've discussed about Texas market volatility. Here it is. We know prices have shot up in places like Dallas, Houston, Austin, San Antonio, and we know the FHFA limits are based on median prices, which can lag behind what's really happening on the ground. So the question is, will that maximum $1,125,000 limit soon stop feeling like a high-cost ceiling and actually start squeezing out the typical move-up buyer, pushing them into stricter, more expensive jumbo loans, even if they aren't buying luxury, just buying a standard family home in a popular suburb? How that plays out could really define housing affordability in Texas over the next few years.